Hello and welcome. In this video, I'm going to talk a little bit about what is going on in the repo market. And I'm going to talk about repo operations, banks, hedge funds, and treasuries, and how all of those influenced the repo market and caused the repo market to spike back in September, which kicked off the Fed enacting their not quantitative easing policies in October. So first of all, what is a repurchase transaction? Repo is a generic name for repurchase transaction, just so you know. And I have this little chart here to kind of give a visualization. In a repo transaction, one party sells an asset, such as Treasury Bonds, to another party at a set price. So for example, let's assume we have a hedge fund that owns a bunch of treasuries and they want to lever up. So they sell those treasuries to the lender of money, which could be one of the primary dealers. You know, you got JP Morgan, Citigroup, banks like that. So they take in the treasuries as collateral and they lend money to these hedge funds. The seller commits to repurchase the same assets from the same party at some future date. Now generally these can be short dated, it can be overnight, it can be 14 days, it can be longer than that, but generally it's shorter. So if the seller were to default on these payments, then the buyer or the lender of money is free to sell that asset to a third party to offset that loss. However, if they don't default, then the transaction just goes the other way. The lender, the bank, will give the treasuries back to the hedge fund, and the hedge fund will return the cash back to the bank. Now, repos are a way for sellers to raise short-term funding by agreeing to buy and sell securities over very short time frames. They function much like a collateralized or secured deposit and are considered a vital part of the financial system. And banks have been increasingly active in the repo market in recent years, lending out surplus money held at the Federal Reserve to generate extra returns in what was considered a safe and liquid manner. So if you look at this chart to the right, you see that since the great financial crisis in 2010, with quantitative easing and all of the easy money policies, bank reserves have gone up significantly. And this has made repo an attractive market to them. Now, why are repos used? A repo agreement can serve four primary functions. One, they're a safe investment for those with extra cash laying around, like those banks mentioned in the previous slide. The borrowing costs are cheap, which is why hedge funds and other parties like to use them. Yields can be enhanced for institutions holding safe leverage or holding safe assets, and by increasing their leverage. And they can provide a means for short selling and short covering, which I'm not going to touch on in this video. So repos are considered safe because the cash is secured by collateral, which is a low-risk asset like a treasury. It makes it easy for the lender of repo to make their money back by selling those secured assets if the buyer or borrower does default on their payments. And yields can be enhanced because a party could lend out a high demand asset to the market, and in return they could receive cash for cheap, which can be used for funding or reinvesting profits, also known as levering up. So now I'm going to kind of dissect what's going on in the repo market based off my observations from what I've seen. And you have to remember there's two sides to every deal. The repo markets are no different. On one side of the deal, you have banks that are sitting on a large supply of cash, excess reserves, whatever you want to call it. On the other side of the deal, you have hedge funds that are sitting on a large supply of treasuries. Banks lend cash to hedge funds, and hedge funds place their treasuries as collateral at the banks. And this enables hedge funds to lever up any trades they make on treasuries. Now, how do they do that? How do hedge funds go about levering up trades using repo? One increasingly popular hedge fund strategy involves buying U.S. treasuries while selling equivalent derivatives contracts such as interest rate futures and then pocketing the difference. As you can see again, since the great financial crisis, we have seen a significant increase in treasury futures open interest. Now, this is an arbitrage strategy that hedge funds use that would generally yield small profits. So, this is due to the close relationship between the two sides of the trade, the treasuries and the derivatives. So, to make this a more profitable strategy, hedge funds will use leverage via the repo markets to increase returns. Now, leverage increasing returns can also increase losses. Now, how do hedge funds lever up trades using repo? In some cases, hedge funds will take those treasury securities they own and place it as collateral in the repo market for cash. They then use that cash to increase the size of their trade to buy more treasuries, which they can place again as collateral in the repo market for cash once again. This is a process that can be repeated over and over to leverage up trades and increase the potential returns of this trade. Now, this was an arbitrage strategy that was once popular among dealer banks themselves. However, higher capital charges have led to their displacement to hedge funds due to hedge funds' greater ability to take on risk. And there's been a growing clout of hedge funds in the repo market. This includes Millennium, Citadel, and Point42, who are all very active in repo markets and are some of the most highly leveraged multi-strat funds in the world. You look at this chart to the right, you have net assets under management and regulatory assets under management. And this is the assets with leverage, and this is their assets without leverage. So you look at Millennium, $38 billion in net assets under management. They're able to lever that up to almost $200 billion. Citadel, $25 billion, lever it up to $194 billion. And Point42, $13 billion, which they lever up to $71 billion. So what really happened to the repo market in September of 2019? On September 16th, the secured overnight funding rate intraday range jumped about 700 basis points. For reference, this is a rate that typically fluctuates about 10 to 20 basis points. The repo rate for that day actually reached as high as 10%. Many speculated that the end of quarter pressures put on banks to meet regulatory guidelines caused the repo rate to spike. According to the Bank Policy Institute, last week's turmoil in the repo markets provided a relatively benign demonstration of how banking regulations have reduced financial market resilience. Tax payments shifted money out of money funds, reducing the supply of repo financing. Basically, in this case, cash available for exchange for Treasury securities, while the issuance of Treasury securities boosted demand. Now, this is one aspect of the turmoil in the repo markets, but remember, the rate spiked in mid-September and not the end of September, when I would expect it to spike due to tax purposes. On the other side, again, that was the supply side of the repo market, but the demand pressures from hedge funds and other sellers of treasuries in the repo market played a role as well. After all, someone out there was willing to pay 10% for overnight lending in the repo market. So let's look at what happened in August and September in the markets. And for this, I'm going to focus on Treasury since this is the focus of the hedge fund trade and their performance in August and September. We're going to look at the ticker TLT, which is the 20+ year Treasury Bond ETF. And as you can see from the chart on the right, from July 31st to August 15th, you saw a massive spike in the price of treasuries. Yields went down, prices went up, and you saw a 13% rise in the price of treasuries. This was following the Fed's first rate cut of 2019 and essentially ended the tightening cycle, which last took place in December 2018. Treasuries surged in anticipation of more easy money policies from the Fed. However, the Fed reiterated that these rate cuts were merely mid-cycle adjustments. From September 5th to September 13th, long-term treasuries dropped 7%. Now, this could be due to the fact that investors realized that perhaps they over-adjusted the price of long-term treasuries, and now we're readjusting to reflect new expectations. So that's kind of an overview of what I think contributed to issues in the repo markets. I believe that much of the volatility in the repo market was a combination of factors which include regulations on banks which made them unwilling to lend at the time, increased volatility in treasuries, which affected those hedge fund arbitrages, and increased issuances of treasuries by the Treasury Department, which I haven't touched on this video, but I do want to talk about more in a future video. Be on the lookout for more of these videos. Let me know your thoughts in the comments below. And if you found this video useful, please hit that like button and subscribe to my channel. Until next time.